Now, my next guest says that current US Treasury bill and cash holdings suggest that investors do not have the confidence that we are at or near the peak in interest rates. However, he says 2024 will be the year that risk will be rewarded. Will Hamilton from Hamilton Wealth Partners joins us now. Will, good afternoon. Thank you so much for joining The Wealthy Effect.
Good afternoon, Danny. Thank you. Thanks for having me.
Okay, so if we had an alternative and cash was king in 2023, is it a case of people stashing their money away effectively in what they think is a good 5% return for 2024 could prove to be a disappointing outcome?
Yeah, look, cash holdings are very high. According to Bank of America, T-bill holdings in the US are at 15.8%. So the last time we saw them at these levels was at 2009. And as you can see there, even in March 2020, when things were really bad in COVID, they're at 15.3%. So it's sentiment. Sentiment is negative amongst investors. And when I say sentiment is negative, they don't believe that interest rates are at or near their peak and they're going to be coming down. And I think that when they all realise, you're going to see quite a rush in, as you can see when things change and these cash holdings start to decrease. So it's very much sentiment driven.
That's really interesting because some of the indicators, the fear and greed index from CNN that they produce, it's an extreme greed reading now. But maybe that's at the margin, because that chart that of Bank of America that you showed us is that people are still highly risk averse. So is it a case of those that are in equities are chasing them too high just in the short term, but really the bulk of the money is yet to move?
Yeah, that's our view. And I've been talking to some private banks in Asia. They're very much seeing this, locking in the TDs. And while I've been concerned about 3 months, they're concerned about people locking in for even longer. So when I spoke to you a few months ago in October, and things were quite negative, and we were sort of, you said we were a little bit standing out because we were starting to get optimistic. That's one of the reasons why we were getting optimistic, is that people were just locking in back in October these 5% rates. And then markets were falling, but people were concerned about, the market's falling, but I can get my 5% in TDs.
Interesting. So if we scan out to 2024 and we look at the probabilities of different outcomes that you're potentially looking at, and it's quite interesting because a soft landing scenario, you're currently ascribing a 50% probability to that transpiring in the US. Is that how you're seeing it?
Yeah, look, I do think the numbers are going to come in the US a little bit weaker than people probably are projecting, but you've got to remember markets look ahead. So weak numbers aren't necessarily a bad thing, as markets do look forward. And one of why I say they're not necessarily a bad thing is because then you're going to get interest rate cuts. And this is the whole thing. We're looking at interest rate cuts somewhere around the end of either side, the end of the first quarter, to get that first cut in the US. So that effect of monetary policy is having it's going to be felt. It is being felt, and it will slow the economy down in the US.
When you're looking at these Treasury yields in terms of also Fed fund rates moving down, and we'll just focus on that before we move back here to Australia, is that predicated on that slowing US growth, or just the fact that real yields are just too high given inflation is trending down?
I think it's very much the effect it's having on the economy. So the fact there is this lagged effect from monetary policy, and it will be felt. And we all say that it's that view that it takes about 6 months to flow through. That's what we believe. You're going to see that and start to see that coming through definitely in the first quarter.
Okay, and Hamilton Wealth Partners have been quite risk averse. You haven't been overweight developed markets. But are you looking to change that position through the course of 2024?
In about the middle of the year, we went from underweight developed markets in about July, I think, from memory, and we went to neutral. We went to also neutral emerging markets. So we will be coming into 2024 neutral, but I think the next move we do will be, at some point, we'll be going overweight both those asset classes. So the last time we were overweight was when we went into 2022. By February, we were underweight.
Right, and that's very much predicated on those cash rates, yields moving down and making risk assets more attractive. Is that correct?
Correct. So we're coming in neutral, but and our next move will be our bias is towards going overweight. Yeah.
Okay. Now, it's interesting that you also touch on private credit markets. And I'll tell you what, it has been, we've talked about this before, it's been an asset class that, having not really been in focus for many, many years, that's all we've talked about all year. And a lot of money has been going in that direction. Do you think there's some potential nasties lying in private credit markets?
Look, I've talked a lot about this, including with you, Danny, and it's about diversified credit, especially in certain parts of our market. It's the new black. And this terrible term, the democratisation of private assets. And I think it's a ridiculous term. And the disparity in the quality in diversified credit is what worries me. There are some great managers out there. There's some great areas to be exposed to. But there's also a second tier, which I get very, very worried about. What I'm also worried about is this: everyone's piling in, and it reminds me so much of hedge funds back in 2007, 6, and everyone went into these on the basis that they were uncorrelated. You were going to see, therefore, as some parts of the market fell, you'd see returns out of these. They had a liquidity, etc., and lower volatility, and they turned out to be the opposite on all three. They locked up. Returns were perfectly correlated and proved to be very volatile. And it brings back some reminiscences of back in the GFC, and I think people just have to be careful. I think that's the key thing from this. Yeah.
So you're not only touching on potential credit quality that's a concern, but also the illiquidity in the product offering should you get a seizing up in markets. Have I read that correctly?
Correct. And I think that like with these hedge fund products, these multi-strategy funds, etc., that you saw back in the GFC, actually wasn't the underlying assets. It was the structures that got locked up. And that's what concerns me again, that everyone's going into something without realising the illiquid nature of what they're investing in. And I think you've got to look at balancing the risk that you're taking with the return that you can get, and make sure you understand what you're investing in, and therefore also the liquidity.
Very important points. Let's just have a look in terms of property. A lot has been made out of parts of the commercial property sector, the office sector specifically, and also more in the US and pockets of US markets which have been heavily impacted by the pandemic. Do you think they're going to recover? What's your disposition towards parts of the property market?
On commercial, we've been standing aside. Everything recovers at some point. So everything's a cycle. But with commercial property, it's going to be about the quality of, again, the asset that you're investing in. So is it A grade? Is it B grade? Its location. I think that's also very important. I think that in 2024 we will start to see some things that are interesting.
Okay.
Not yet. It's too early though, just at the moment.
It's too early. Okay, one thing that is a final piece on your outlook for 2024, which I find really interesting, is these elections. Can you touch on the extent to which the world, global GDP, a huge percentage, is going to be in the throes of an election in 2024?
Yeah, well, look, well over 50% of the world by GDP is going to have elections next year, be it Taiwan, India, the US, the UK, just Indonesia, just to name a few economies. Now, elections and politics usually do not influence global GDP. However, at a more micro level, and especially, I suppose the two countries that everyone's going to be watching mainly because of the candidates, and there are effects with these candidates, is both Taiwan and the US, and they potentially could have an effect.
Yeah, certainly something to keep out for. And just last but not least, your disposition towards domestic equities here in Australia.
Yeah, we're going into 2024 on against strategic benchmark. We're going in underweight Australian equities. We don't expect the interest rate decreases in Australia, as you will see offshore. That's the first thing. Secondly, the composition of the index, banks, materials and resources, they're going to face some headwinds that you're not going to experience elsewhere in the world.
And just on a short-term tactical basis, markets, have they run a bit too far just at the moment?
Yeah.
Has Santa and his sleighs got too exuberant?
I think so, yeah. Look, I think that you're going to be rewarded for having risk-based assets in your portfolio during 2024. But I do think in the very short term, yeah, things have run really hard. It's incredible.
It is incredible. Well, Will, thank you so much, as always, for joining us, and wishing you and the family a very Merry Christmas.
Likewise to you, Danny. Thank you very much for having me.